The first couple of topics Michael is going to share with us and talk us through. I know that everyone on this call knows everything that's involved with selling a property. But in terms of selling a business, a service business, and in particular a conveyancing business, there are many, many differences, and Michael will talk us through some of the key elements of those. Michael then will also talk about, well, what determines what a conveyancing business is worth to different types of potential buyers? What are the things that we need to be aware about? I'll then come back on and I'll share with you a high-level summary of the most significant piece of research done into the conveyancing industry by Deloitte, one of the big four global consulting firms, which was published in 2018 at the start of 2019. So I want to take you through some of the things that they predicted. They didn't predict COVID, but they predicted a number of other things which the pandemic and COVID has accelerated happening, as well as they have a number of other sort of predictions around what the future of the industry might look like. And that's very important when it comes to thinking about what your business is worth and could be worth, and what your own plans are with respect to running and building the business, or possibly selling it, or possibly retiring. Then we'll get Jill on, and I suppose Jill, we're really keen to learn with you about some of these views about the future, given that you've been involved in the industry right through, right from the beginning, as well as you've seen and been involved in many of the consultations that have led to a number of the changes in the last half a dozen years or so. And it'd be really interesting to get your perspectives on what the future might look like, as well as, you successfully sold your own practice. And so having a chat with you about what you learned through that process, and perhaps what you would have done differently now based on having gone through it, to get you to share that with us. And also as someone who's, made the transition into retirement after an incredibly busy 30 plus years in the profession. And as we all know, running our own businesses, it never leaves us. And when we leave the office, we always take it with us. And it'll be quite interesting to hear from you, Jill, around for those people starting to think about perhaps retirement, or perhaps leaving the industry and doing something else, some of your perspectives on that. We'll get Michael back then to talk about the market for conveyancing businesses and what's driving valuations at the moment out there, as well as to talk through key elements of a strategy. Now, when I use the word strategy, what I mean is integrated set of actions. So actions to maximize the selling price and perhaps the cost in time that you may have to contribute to stay involved with the business. But we'll get Michael to talk us through that, given that he's worked with more than probably 150, I think, on my last count, in helping people successfully sell their small businesses, a number of which have been in the conveyancing profession. We'll then take some questions, and then I will wrap everything up.
Firstly, there's a common parallel drawn between selling a house and selling a business. And the bottom line is, to a point, that's very helpful. After that point, it can become very detrimental. So I'll explain now some of the similarities and some of the differences. But if you go beyond that point, the cost to you is ultimately time in not selling your business, and obviously a financial downside. So when we talk about the similarities, selling a house, selling a business, both emotional. There's no question. The process for selling can be public or private. There is a great need to undertake pre-sale improvements. So look at your business, look at your house, work out where you can add value to the house, make it more sellable. When we talk about doing that in a house sense, we're talking about the location, the land size, the foundation. There's some fundamentals as well with the business that you should look at, and any buyer will look at. In terms of the differences, the timeframes, essentially we're talking months with houses, and we're talking years with businesses. So it's so important that if you take one thing away from today, it's going to take you a lot more time than it would to sell a house. The buyer types can be quite, they're going to come from within the industry, within your industry largely, or from the legal profession, but they're going to have all sorts of different aspirations for your business. So they're going to have different needs. It's going to require a much more nuanced process. When it comes to selling your house, you can typically plan on a clean exit. You sell, you're out of there. Not so with the business. It can be in your interest, but often your time after selling, some of it will be needed back in the business with the new owner. And look, that flows into the settlement terms where you sell your house for $1 million, you get your $1 million, and then with a business, often there's a price that's paid to you in components. So some upfront at settlement and some over time based on performance of the business. So I think that's the key points I wanted to make about when the usefulness of comparing your business sale with a property sale. In terms of the next slide, Bill, what we want to do, just briefly, is talk about the value of a conveyancing business. A couple of really important realities. When we talk about evaluation, it's based on facts, but it's an opinion of value by someone who has variously a very substantial professional background and experience, and can also be pretty light on. So there's some facts in the valuations, but the overriding takeout is that they are opinions of value. And when it comes to a house, you can quite easily track what houses have sold for, CoreLogic database as an example. When it comes to trying to find values for businesses sold, it's incredibly complex. Reality is, all potential buyers that you would see in showcasing and potentially trying to sell your business will see your business very differently in terms of the value to them. It's got a value to you, but trying to unpick what it's worth to them is part of the secret of a good success. No question, the better prepared you are, the better sale outcome you'll get, the better sale price. That is a function of time and patience and strategy. The drivers of business, commonly understood, when we get down to valuing a business, we're talking about what profit does the business make. And if you hear the term profit multiple, what we're talking about is the profit the business makes, and the multiple being the number of years of profit a buyer will potentially pay for it. Multiple ranges can stretch from 1 to 5, massive range. What it boils down to from a buyer's point of view is the predictability of that future profit. So how can they sustain whatever you've been doing? If you're well prepared, it's easier to sell. If you create competition in your selling process, so that means some advertising, but a lot of off-market activity to try and find the buyers for you, you'll increase value, and it will be a driver of success. And future potential is always, we don't want hockey sticks. What we want to do is be able to point future buyers or future owners of that business to where and how the business is going to be sustained and maybe increased in financial performance. Thank you, Bill.
Just a couple of questions, Mike. I remember many years ago teaching accounting at Melbourne Uni. And when I was doing my MBA, our accounting professor said to us that when we learn accounting, we should realise that profit was a pack of lies agreed upon by accountants. So you've got the word adjusted there and profit. So again, can you just talk us through, is profit what our accountants are showing is in the profit and loss statement and the tax return when it comes to potential buyers of a conveyancing business looking at the profit?
No. Profit, the tax returns that your accountants prepare, I won't accuse them of being a pack of lies, but let's just say that there's a few tactics in there to reduce your tax. That's what an accountant will help you with. And you can, and most private businesses I've ever dealt with will have private expenses in the business, which is part of the reason you're in business. When it comes to selling, that we take that raw tax profit that your accountant produces and we adjust it for things that aren't necessary to keep running the business as a pure business without any of the owner's discretionary expenditure. So every business I've ever looked at, all of the businesses of all the listeners to the webinar will have a bottom line that's about minimizing tax. We need, your business sale advisor will need to take those tax returns and adjust them for personal expenses. For other examples are non-recurring expenses. You often push through some capital items that get expensed in the profit and loss, but you might own that equipment or that software for 10 years, so you're going to get 10 years of benefit. So the write-off in 1 year is again understating your profit to reduce tax. But so that, yes, it's there's always a process. It's not unnatural. It's normal to take those raw tax returns and go through the adjustment process.
Thanks, Mike. I know that I was in Darwin recently and then also in Cairns seeing some Business Advantage members, and I saw a couple of businesses that were involved in property legal services and conveyancing, and they had cars that they actually used with one of them being wrapped with the logo of the business, etc. So I know that the motor vehicle expenses is often an area in a number of small businesses, not just conveyancing businesses, where there are often adjustments. As well as depending on who owns the property, if you're using an office in a building that you own yourself, in terms of what the commercial level of rental and lease would be, etc. So this adjusted profit is a process that every business owner that is looking to sell will need to go through, because every possible new buyer is going to look at what are the assets of value that I'm looking to get here with respect to buying this business. And that's, I think, to some degree is represented by this concept of the multiple. So the number of times adjusted profit that someone's prepared to pay. Okay, I want to talk a little bit about Deloitte and the significant piece of research and report that they published towards the end of 2018 and 2019. So this was in the pre-COVID-19. None of us had heard of it. None of us had lived through what we've lived through to date over the last 2.5 years. What the consultants at Deloitte did is they went out and looked at the research that was available from places like the Bureau of Statistics, property sources. They spoke to property titles offices. They spoke to organisations like PEXA, providers of software to the conveyancing profession, and they came up with a point of view around what might the future look like and what sorts of things were driving what that future looks like with respect to the profession. And they broke some trends into two key areas. And look, I won't go through these in a lot of detail because all of you have been experiencing them, not only in your business, but with respect to the way you live your broader life. The first one is around trends that are happening, generically in the industry. So if we sort of look over there to the top left-hand side, it's going to evolve. It has evolved very quickly in the last couple of years, which is going to have an impact both on clients and also the professionals, the practitioners that undertake the conveyancing work and activity. Now, we're seeing across a whole range of industries that customers increasingly have access to a lot of information on the internet, a lot of people's points of view, a lot of people's reviews. In addition, in the last couple of years, as they've become more reliant upon doing things from their smartphones, from their other devices like iPads or from laptops, etc., there's a preference, particularly among younger people, for interacting through the screen, as opposed to necessarily picking up the phone or necessarily operating face-to-face. And if you think about the conveyancing industry and that part of the market made up of first-time home buyers that have never used conveyancing services before, buying their first piece of property, and it may not be a home, maybe their first piece of property is for investment purposes, that age group is very, very digitally savvy and screen oriented. So we're seeing a number of new businesses already starting up in the whole area of making the process of finding a real estate agent, dealing with the real estate agent, having the property promoted, finding someone to help move house, finding someone to help you with this thing called conveyancing, which the first time home buyers never heard of until they've signed a contract to buy a house and then they start hearing about it. So we're seeing a lot of new businesses integrating technology, putting technology together with respect to impacts on the industry. If I think about the technology trend, everyone's heard of Bitcoin, everyone's heard of cyber currency. It sits on some technology, which is called the blockchain, and that's used for a whole range of different types of things and industries. Cloud now, we thought cloud were things in the sky until just a few years ago, but increasingly software for doing your accounting, for managing your practice is available on the internet. You can pay by the month for it. Cybersecurity is now hitting the mainstream consciousness of every Australian. We've seen it more recently with Optus. We've seen it with Medibank. Down here in Melbourne, 2 private schools in the last 24 hours have gone public with the fact that most of their school records have been hacked and taken away. I know that all practitioners that are participating today are very aware of the significant risks to their business and to their clients with respect to these threats from a cyber perspective point of view. Electronic contracts and signatures, you're already seeing a bunch of that stuff implemented. The majority of you are now using something like the PEXA platform with respect to, the management of that final settlement process. Increasingly, we're going to see the automation of things that in the past have involved tapping into keyboards. So the word for that is sort of robotic process automation. And then there are things you'll be hearing about like artificial intelligence, the Internet of Things, where different sensors are placed on different devices or different locations or different pieces of property. So the rate of change and acceleration in technology, we've seen a lot in the last couple of years, particularly as our clients have been interacting more with us digitally and more remotely. Our employees have been working from home, but the rate is only going to increase with respect to the other things that are in the pipeline already and that are coming that are going to fundamentally change the nature of the industry. Now, several years ago, I worked very closely with MYOB to help their team develop a strategy for helping the bookkeeping industry make the transition to the world of the cloud. So several years ago, if you used MYOB, there was no such thing as Xero then, but you had it you with someone who was basically registered by MYOB, a registered bookkeeper, who gave you a disk and set it up on your computer and set up the chart of accounts and then taught you how to do the data inputting, etc. Versus moving over to now they're paying so many dollars per month. It's automatically getting the information from the bank account. So bank feeds, as they're called with accounting, saved an enormous amount of data inputting requirement for bookkeepers. Still was the need for doing a physical reconciliation and those sorts of things, as well as interfacing with how the tax return gets prepared. But you see what's happened in the bookkeeping industry is going to start coming into a range of other professional services industries. And conveyancing is also one of those that will be impacted. There's other technology like augmented reality or virtual reality, and you're already seeing that with the way you can do an inspection of a home now. We saw any number of homes sold. Had I said to you in 2019, we're going to see up to 15% of homes sold in 2020 in Victoria, and no one's even going to go and inspect them, you guys would have gone, and the real estate agents would have gone, no way, that's never going to happen. Yet we're seeing now the use of that technology and the comfort that people have got, particularly when demand is running hot, the comfort with people buying things truly sight unseen, which technology is helping facilitate that taking place. Now, the next thing that Deloitte did, so Deloitte looks at these sorts of trends, the extent to which people were already taking up some of them with respect to running their practice, and then they start forming a view of, well, what are the future scenarios? What might conveyancing firms and the actual practice, the profession of conveyancing, what might it look like in the future?
So as you said, we did some, we constantly track what's going on in the business for sale market. We did some specific work around conveyancing over the last couple of months. The key finding, I think, is in the right-hand column. There's never a great number of businesses publicly for sale, if you want. Certainly there's activity going on behind the scenes. For the businesses that were publicly advertised, this is the key takeout. The asking price varied between 0.44 and 1.25 of revenue. Where they talked about the asking price in terms of a profit and a profit multiple that we addressed earlier, it ranged from 1 to 4.2. Massive variation there in the asking price. So it really does emphasize that there's the ability, if it's way overpriced, you won't sell. If it's underpriced, you'll do yourself a disservice. But just you've got to be able to properly get a handle on what your indicative value is before you go to market. I suspect that some of those businesses would sell quickly and some will never sell. So, and partly packaged up in those asking prices, there may well be what I referred to earlier, which is the owner needs to stay in the business, and some of the sale price would only get paid later on, subject to performance. So, in terms of the buy, I'll go back to the left. The buyer types, really, when you boil it down, this is proven out in more of the off-market activity where there's sales approaches from within the industry. Your buyer is largely going to be another conveyancer, and they can be anywhere from a newly qualified conveyancer looking to fast track to a business rather than go through that period of time of trying to build. It could be a similar size firm in the local territory, or it could be a larger firm. And Bill talked a lot about consolidation, and the takeout is going to be a lot more of these off-market transactions where you as a practice owner get approached. The second kind of buyer is in many states, not necessarily all, will be a law firm. They have a very important need to undertake conveyances as part of their broader legal service. So often they will look to buy a firm to fast track that. The one-stop shop thing where Bill talked about, also per the Deloitte report, possibly broader service-based firms where they've got a conglomerate of an accounting, tax, financial planning professionals all around wealth and property. So they're the buyer. Anybody else that is is looking to get in the industry, doesn't have the license, is going to be pretty much a waste of your time. It's going to have to be somebody who knows and is licensed. What I take out from that is that there are basically, this is the theme, two types of sellers. You're prepared and ready with a plan to try and prepare for sale, or you're ready in case somebody knocks on the door and timing may not be perfect, but you have the right way to deal with that inquiry, or to harvest that inquiry. Say it's not the right time, but come back to me in a year. The prepared ones will, the two where most of the activity is, will be competitors, but also oftentimes when the owner of a practice is getting to a particular age and state of mind, or they talk to their employees, the employees will tap them on the shoulder and say, I'm interested. So again, be ready. The other type of seller is just unprepared, and that's where you will fall quickly to either not selling, or to the very, very low end of those asking prices. So how do we wrap that up in a strategy to sell and a strategy to maximize your value? At the top of this is it's a major disappointment not to be ready and not to be able to realize that some value, the right value from your practice after 20, 25, 30 years. It's very disheartening, and it's financial, it's emotional. So in terms of the 7 steps that we mapped out, as much as you can, remove yourself from the day-to-day, because it demonstrates that the business can be run by somebody else. It's not always feasible, but it's also not binary. There are things you can do to kind of move from 5 days to 4 days to 3 days. So it all helps when the buyer looks at a business. You've got to keep building. If you're going to be in the business and you haven't sold the business, you need to keep reskilling, building your knowledge about what's going on in the industry, so you're better prepared to sell. And if you need to, you partner with a coach or advisor to help you do those sorts of things to increase the value and flexibility of your business. Third, get a sense of value on your business today, whatever you're doing. If you're anywhere up to 5, 6 years out from an ideal sale timeline, get a value today. Very powerful to understand what it is. and therefore where you can start to increase that value. And I go back to that slide, the range of asking prices, they're not proven sell prices, but my own experience is you can move the dial significantly from potentially 0.5 of revenue to 1 times revenue, even higher. So that all comes from understanding where you are today and putting together a good strategy. Said it many times, preparing early, straight away now, a couple of months to 6 months to get properly prepared. And if you are properly prepared, still 12 to 24 months is a realistic time frame, so that you're not seen as desperate, need to sell tomorrow. That's so again, to draw the parallel of the house, you can pull the lever, drop the price and sell it pretty quickly. You just can't do that with a business. You've got to prepare a compelling story about why your business has been successful, how it's going to be successful in the future. Part of that is cleaning up the financials, adjusting your accountant's tax returns to show over 3 or 4 years how your business has performed. Because the time frames are going to be 12, 24 months, you can't just set and forget those financials. You have to keep coming back probably every quarter. When you do get a buyer close to buying your business, they're going to look at and they're going to pass over what happened 3 or 4 years ago, and they're going to start looking at what's happening this month compared to last month, last year. So being on top of your numbers is critically important. Vital to have a communication plan. We're all attached to our business, but the worst thing that can happen in the case of a business sale is that key staff or key clients, key referrers find out it's for sale from somebody else other than you, the owner. So you need a script. You need to have thought through who you're going to tell and when. And there's no formula. Just remember that the worst thing that can happen is somebody else finds out about it. So yes, you've got to have confidentiality around the process, but you need to orchestrate that process and tell people at the right time. So much of your value of your practice is tied up with staff and clients. So they get jumpy, there goes, a certain percentage of your business. So in terms of the final part, selling, the services you're going to need to tap into is that valuation, assessment of value today, map out your strategy, we've called it the business information memorandum there, that's the business story. You need to think about advertising and promotion because your buyer is going to come from within the industry. Just broadly advertising on the business to sale portals is largely irrelevant, and you're better off to map out who you know in the industry and who's in the local area or who are the national firms that are acquiring. And lastly, you're going to need to pull together and have at your fingertips a good deal team. So it might be your coach or advisor who's helping you get the business more profitable, more ready for sale, a business broker possibly, likely, also a lawyer to guide you through the sale process from when you get an offer to accepting the offer and understanding what's in the offer. So that's pretty much a 7-step strategy for you to sell and maximise value.
Well, in fact, Mike, the first one is from Paul, and his question is there anywhere where people can list their business online for potential sale to other conveyancers or lawyers? Now, you've just talked a bit about those for sale type websites, but you've also talked about the most likely buyers will be other people already in the industry, or possibly employees, possibly law firms, possibly other local businesses. I suppose also potentially people have just got their license to be a conveyancer or met the regulatory requirements, and rather than starting from scratch or joining a franchise, they want to buy something that's existing. Is there anywhere specifically to promote businesses for sale to conveyancers and lawyers?
There are a couple of specialised but not very large portals that promote broadly legal services. I can share through the notes after the webinar. I think it's called Legal Practices for Sale. I can't quite remember the URL, but there aren't many. One of the things that I've done in past is the AIC in Victoria, for example. The industry bodies will have sometimes a newsletter or a database which you're tapping into your industry. But yeah, there's one other, and I can't. I think it might even be a specialised seller of law firms. So if you're happy, I can share that afterwards, or both of those afterwards. But there aren't many. Often it's about building your own list of who ought to buy your practice or your business.
So the next question I've got is from Tony. In terms of the changes and integration of various technologies, do we see they're going to be a plus to the future of one's conveyancing business and its value for a prospective buyer? Mike, do you have a point of view on, as more of this technology is available or tools, as Jill called them, and they get more integrated into these practices, do you think that potentially has any impact on the value to a prospective buyer?
Well, look, if as you said, with practice management, if technologies are aligned, that's something that's really, rather than switching systems. If the scale of the business, if we're talking about a highly personalised, smaller, 1, 2, 3 person practice, technology for efficiency, is worthwhile. But to put in place large back end systems, it's not economic. It might be if you've got $1 million a year practice. So whatever any technology, any good or effective technology will probably make it easier for the business to be sustained under new ownership, because it's taken out the human, or some of the human, more automated parts. But as a practice owner, you've got to invest in improvement in your business, but it's got to be relative to your scale. So putting in a super expensive system, it might just be a bad investment now.
Look, so I think what I'm hearing there, Mike, is, so if I think about your question, Tony, as long as the cost of implementation of whatever these technologies are is, going to increase the profit or the multiple, the adjusted profit or the multiple, significantly enough, it's a return on investment decision. Does it increase the value to the buyer? Yeah, well, you might spend $50,000 and it increases the multiple by another factor of 1 times your income, and now the business is worth an extra $150,000. So it's that trade-off around whether the time, money, and effort in terms of what you're investing in from a tech point of view is going to lift it. So I think about it from the perspective of just selling a house, right? Like, do you want to have the thing fully renovated and totally available for someone who can just buy it and walk in and not have to do anything? Or is it like, no, leave the kitchen and a couple of other things, spruce up the bedrooms and stuff beforehand, but leave them some things to do to add some value? I think it will come back to the size of your practice, who's the target buyer type, and then given what you've already got in place, are there a couple of rooms of the house or a couple of functions or parts of the business that could be better digitized that is going to, move that multiple needle or that profit needle? Got a question for you here, Gillian, from Martin, and he's recently qualified as a conveyancer. So he's legally able to practice without supervision, and he's sort of at that stage of, well, should I start from scratch? Should I go and buy, a franchise? He's been talking to a couple of businesses that have conveyancing franchisee-ships available, or should I be, chatting with, looking to find someone who's an individual practitioner? What are your thoughts around those options that he's got on his table?
There's no sort of defined answer to that. I mean, some people, when the franchises started to come in the 1980s, some people saw the advantage of that because they got all the template documents. But you've got to ask the question, what else is being offered in the franchise? If it's just an advertising thing and templates, not sure that that's a great advantage, because you need someone to mentor you. If you don't have the relevant, you would have had the relevant experience to get your license, but you mightn't have the depth of experience that you really need. And sometimes working in the business yourself and thinking through everything and doing your research and all those sorts of things you might get further than if you just use template documents and had no mentorship behind you. So it's not an either or. It's just what feels more comfortable for you.
That makes good sense to me as well. Thank you for that, Jill. The question from Tony, and you're probably best placed to answer this one, Mike. This business has been operating for 40 years in WA, and the office is located in a regional area, significant town, but it's not in Perth. But the work is all across the state. Would this be considered, added value to the sale of the business? The business has now got second and third generation clients. So is it a potential extra plus or positive when it comes to valuing that business, given that it's not, in downtown Perth?
Look, it's entrenched in that area. I think it says that the business is probably quite sustainable with second, third generation clients coming through. So Perth, bigger place, competitors can pop up, everywhere tomorrow. I imagine that the local relationships in a regional area where I live in a regional area, they're possibly more important, and so I think it's net a strong positive because it points to a sustainable business. The risk might be that it's really good, and when somebody else is going to see that as well.